we're going to be exploring one of retirement planning's oldest topics, which is how long will $1,000,000 last us? Now, after years of helping people confidently and successfully retire, I get this question all the time. How long will $1,000,000 last? And there seems to be this mythical illusion, if you will, around $1,000,000, why it's so special or sacred. And so in today's video, we are going to tackle how to accurately calculate your retirement timeline, how much you need, and how to help you avoid these dangerous pitfalls when it comes to that $1,000,000 mark and figure out what number you actually need. So without further ado, let's go ahead and dive right into it. This $1,000,000 illusion that we'll call it, it happens whenever we focus on hitting a number on a balance sheet rather than figuring out how much income we actually need. Now, in behavioral psychology, we call this anchoring or benchmarking. It's this phenomenon that occurs when we see this number on a balance sheet. We're not going to be happy unless that number continues to grow. And what happens when the market goes down? Well, we're going to continue to have our happiness be dependent on if we can get back to that number. And here's where it's wrong for two reasons. One, to me, it's just a number. It's arbitrary. That tells me nothing. It doesn't tell me how much you're spending. It doesn't tell me what you actually need. Maybe it's more, maybe it's less than $1,000,000. So we have to figure out how it's personal to you. And number two, the second reason that it's wrong is you can't tie your happiness to an arbitrary number because you're going to be miserable every time the stock market drops below that. So instead, what a better solution to do, and what we'll cover in today's video, is how do we figure out what our number is? How do we figure out what we're spending? And how do we cancel out all the other noise around that? Okay, so what we're going to do today is figure out how to build a plan that helps you arrive at knowing what your number is and creating a consistent, reliable, and sustainable plan to help support your retirement. Now, one of the things that's most frustrating for me as an advisor is to see all of the different types of information that's out there. I'm going to show you in just a moment an article that I wrote on all the different retirement calculators, all the different methodologies, and how, as you're sitting here, would you know the correct one to use, right? We could use something like the 4% rule. That states that we take our starting amount, we multiply it by 4% of our portfolio, and that's how much we could spend. And that's our starting point. Each year, we're then able to spend more by adjusting that same number for inflation. We have the 25% rule that says, let's take 25 times our annual spending and multiply that. And once we get to that number, then we're good to go. Then we have other more technical ones like the go, slow go, no go years that says we're going to do a majority of our spending early on, and then it's going to taper off. And then there's the retirement smile method, which says in the early stages and the late stages of retirement, we spend a lot more. And it's in those middle years that we don't spend as much. So early retirement, early 50s, 60s, front half of 70s, we're spending a lot going on vacations. And then in our late 70s, early 80s, we're not spending as much. And then in our 90s, we're spending more on healthcare and final costs. Now, what is a retiree supposed to do? What do you do with this information? We have to make it personal to you. And so the method that I love, and I think it's most flexible, is what's called the guardrail approach. It says, let's start with our portfolio. Let's use history as our guide. And I'm going to put up what's called the Trinity study here in just a minute, where we could look at historical distribution rates over time, depending on how aggressive stock to bond our portfolio is, which tells us then, can we adhere to certain spending threshold? Because with the guardrails, what it's saying is when markets do really well, and we know on average, markets do really well 8 out of every 10 years. We'll have those bear markets, those types of corrections, those will happen. And when markets are going well, we can afford to spend more. Now, that comes with a huge caveat. When markets are not doing well, that means that we have to tighten up our spending, right? The name of the game with retirement planning is flexibility. So if we want that longevity, we have to be willing to make some sacrifices on both ends. So what the guardrail approach teaches us is that it gives us these set limits, these boundaries of where our spending could go without ever being in jeopardy of running out of money. Something I found that was really interesting. One of my favorite books called Just Keep Buying by another Nick over at Ritholtz Wealth. He mentioned spending decreases by 25% by the time we hit 65. And this is in line with what financial planner Ty Beneke also said, where every 5 years, our spending decreases by 15%. And I agree, looking at traditional logic here, whether it's the guardrail approach or even the smile approach with retirement spending, is that once we get into our back half of our 70s and 80s, this is absolutely true. And historically, what we're seeing is there's a lot of spending early on in retirement. And so one of the things that I want to share with you, right, you may or may not know this, I'll let you in on a little secret. no two plans are identical. Just like people aren't identical, what matters is maximizing what's most important to you, your money, and your experiences. How do you align that? So the short answer, and what we're going to focus on during today's video, is I don't know how long $1 million is going to last you. But what we're going to unpack is the different ways to calculate how much you could spend, hidden costs to be able to look out for because they're going to be there in retirement, how to hedge against inflation and other market risks, and most importantly, how to minimize and reduce your taxes. We know $1 million is a really big number, but I do want to show you that it's not what it used to be. We could use the old adage of, you remember how much groceries used to cost, or a gallon of gas in my time, or whatever it is. But what's really interesting is this $1 million mark. It used to sound like a really big number, especially in the 80s and 90s. But again, going back to that book from Nick called Just Keep Buying, one of the charts, and I'll show it up here on the screen in just a minute, is the erosion of inflation over time. And what we see with inflation is that it cuts your dollar amount in half about every 23 years. And it's based on the inflation rate. So let me go ahead and put this up on the screen here. And what we can see is based on the interest rate, how quickly your wealth is eroded. So we see it at a 5% interest rate. It wasn't that long ago that rates were at that level or even higher. It only takes 14 years for your cash, or your investments rather, to get cut in half. Right? This is the power of why we need to be invested in the market to help protect against that hedge that is inflation. We need to be investing in companies along the way that are building, growing, and accumulating our wealth rather than leaving our money under the mattress. Because what we'll see here is that inflation, it's the silent killer. It creeps in. And this one makes total and complete sense. At 3%, which is the long-term average, what we've seen over the last 20 years, dating back to give or take early 2000s, takes 23 years. So if we take the year 2000 and where we're at today, 2025, give or take the maths right there. And what we can see with our average rate is that $1 million isn't worth as much. It's worth $500,000, right? So in order to have that same million, we now need 2 million. Now, when we start thinking about that $1 million, not only do we see inflation takes that away, but there's some other risks that I want you to be aware of. The first one is, with our 4% rule, it's a back of the napkin math. That's not meant to be your end all be all, right? That actually suggests that you're a static spender for the rest of your life. It's saying that you can only spend this much. And what I know in working with clients for decades now is that we don't spend the exact same amount every year. Life happens. We go on vacations. People get sick. Babies are born. We buy houses. There's something that we want to purchase, so on and so forth. So our spending changes from year to year. And so that 4% rule is really, really limited. And just if we do simple math here, if we have $1 million at 4%, that suggests that we're only spending $40,000 a year. Now, you might say, hey, Nick, I have a pension, I have Social Security or rental income. But that big $1 million number, when we back it out, the point I'm trying to make is our historical back of the napkin math, 4% doesn't take us very far. Right? That breaks down to about a little over $3,000 a month before taxes. Okay, so we've covered 4% in spending. We've covered our inflation reality. Let's talk about another hidden one, which is healthcare. When we get into retirement, depending on what age, we're either going to have to pay for open market care, healthcare, from, let's just say, late 50s to 65. We're going to have to pay for that out of pocket. And then when we hit 65, we're going to have Medicare. And now Medicare comes with its own expenses. We have our monthly premiums. It doesn't cover long-term care. We have copays and deductibles too. So it's not just a blank check that because we have Medicare, there aren't additional expenses. There are a lot of things covered. Long-term care is not one of them. Now, let's back up real quick. What if we're sitting here saying we want to retire at age 60? Well, we have that 5-year gap before we hit Medicare. And so what we'll have to figure out is when we go onto the open marketplace through the Affordable Health Care Act, we want to figure out, well, what plan do we qualify for? Let's keep our same doctor. Do we want an HMO or a PPO? And what's going to be really important is it's not needs-based, right? It's not based off your net worth. It's based off your income. So when we're looking to qualify for that healthcare, one of the things that we work in going through with our clients is saying, what is our income this year? And so if we've watched some of our videos, we know that some of the proactive tax planning work that we do is understanding where we take our first dollar from. And so in these first crucial years leading up pre-Medicare, it makes sense to have that brokerage account. It makes sense to have a war chest full of cash and high yield savings. It makes sense to be able to have, whether it's treasury bonds or other types of CDs, because these investments are taxed much more favorably than taking money out from an IRA or 401k. So let's go ahead and keep that in mind. Now, a couple other factors that we want to take into consideration. Longevity. People are living longer now, so we have to stretch that out, that 4% rule. And a lot of the math that we've talked about with retirement spending assumes a 30-year retirement. In a lot of those figures, it assumes that your money's depleted. Right? One of the things that we talk about, and I wrote about an article on this that I'll link into the show notes, is what's called sequence of return risk. What we're doing is we don't know what the sequence or what the expected return of your portfolio in the market is going to be the year after you retire, the 5 years after you retire, 10, 15, so on and so forth, right? And that sequence can have significant impact. Think about the difference between retiring at the bottom of 2008, and we just see 20 plus years of a runway of great financial markets, or we retire ahead of that, and now we have a nasty bear market that we're dealing with. The second thing when it comes to longevity and this risk that William Sharp talks about is we also don't know how long you're going to live for. And so that is a big reason why just having a benchmark number like $1 million doesn't tell us much. We need to understand, how long are we planning to live for? How long are we planning to draw this plan out? Those types of things. And so what I really want to showcase on is when we look at the Trinity study, it tells us that if we're somewhere in the 4 to 5% distribution rate or even less, we give ourselves a fighting chance for however long we need our retirement to be. The big one that we have not talked about yet, can you guess it? It's taxes, right? What we talk about all the time with our clients here at Swell Financial is it's not what you earn, it's what you keep after taxes. And so part of our job, you've worked really hard for your money, you've saved, you've hung in there through a number of bear markets. What we now have to put together, once we figure out that number on how much we need for retirement, is how do we get that money out? What's our plan? What account do we draw it from? Because if we make one misstep and we take a large amount out from our IRA, we're looking at some pretty significant taxes. Now, if you're still uncertain about how much you need to save for retirement, what I want you to do is click on the link in the description below and fill out the questionnaire. And afterwards, I'm going to send you a personalized video breaking down exactly everything that you need to comfortably retire. Can you see why we're talking about why this $1 million number seems so subjective? Everybody's going to go in different directions with retirement planning. Some people are going to go back to work. Some people are going to go travel. Some people are never going to be heard from again because they're off the grid and they're living in the woods and that's what they want. But whatever your number is, it has to be specific and unique to you. So let's focus on the things that we can control. We know how much we could spend. We know how we could build our portfolio. We know we could pay attention to taxes and where we take our first dollar from. Another couple that we really want to focus on too is our mortgage. Whether you decide to rent or you own your home, trying to pay your mortgage off before is such a game changer. Now, on that same note of having a mortgage that's already paid off, going into retirement and controlling the game, bringing those expenses down, another big factor is what other sources of income, fixed income, can we have coming into retirement? Because for every extra dollar that we have coming into our pocket, that's one less dollar we don't have to take out of our portfolio. And you know what that means? If we're not taking it out of our portfolio, it's growing, it's compounding, it's participating in the market growth that we're seeing year after year after year. So some of the ideas that we look at with what are fixed sources of income that we could focus on that allow our investments to grow, and we can leave that alone. Well, it's Social Security, it's a pension, it's rental income, it's interest, it's dividend, and you know what? It's even part-time work. Because by having any of these or all of these sources, that's, again, as I mentioned, less money that we'll have to pull from our portfolio. What's so nice about this is having that extra money come in. Not only does it put less reliance on our portfolio, but it gives us this psychological freedom to say we have money coming in, regardless of what's happening in the world, the market, politics. I can think of a handful of clients that I work with who don't have the biggest investment account balance. But what they do have are several of these sources that I've mentioned before, where they have a pension, they have Social Security, their mortgage is paid off, they've done a good job saving. And what this does, because they have more money coming in from these fixed sources than they have coming out in their living expenses, this allows their investment accounts to be a lot more aggressive. This allows them to have a heavier concentration to stocks. And we know over time that's going to have, right, a higher growth rate than a balanced or more conservative portfolio. And so, again, nowhere in this do we talk about the $1 million mark. Nowhere in this do we talk about a number they need to benchmark to. We're focusing on what's best for you and your plan. So I'm telling these clients, look at everything you have. It's not about an arbitrary number. It's about, do we have enough money each and every month? And if we do, how does our portfolio align to get you to that number? Now that you've seen the real reason why retirement savings disappear way faster than before, as we've gone through all those hidden risks, and why traditional benchmarks or headlines like $1 million is what you need isn't the best way to plan for retirement, we need to understand what it is in our power that we can do to ensure that we're ready for retirement. So I hope this video was helpful. If you want to be sure your plan is built to last, that all those risks, it's accounted for, it's time tested, it's battle ready, go ahead and click the link below in the description. Fill out that questionnaire. We'll get back to you with a video on where you're at today, ways that we could help out, and actionable steps that you can use to strengthen it. So until next time, we'll see you at the next video.